Hello everyone, my name is BukkyNG, and today's module will be focusing on what I call retire at 40. We'll be learning about how to invest more to work less, and we'll be focusing on this topic from a Nigerian perspective. Retiring at the age of 40 would usually sound like a distant dream for many, especially in Nigeria, because we face a lot of financial challenges and economic uncertainties. However, I feel like with the right mindset and financial education and a commitment to learning about investing, it is possible to achieve financial freedom and retire early, even in Nigeria. In this presentation, we'll explore how Nigerians can take steps to invest more efficiently and secure a future where they can work less and enjoy life to the fullest. Before we focus on investing for retirement, it is important that we understand the unique challenges and opportunities that come with living and working in Nigeria. Our country's economy has its ups and downs, and this could usually be attributed to things like inflation, currency devaluation, political instability, and just generally a lot of dysfunction in terms of structures. However, I also believe that because Nigeria boasts of a young and dynamic population, abundant natural resources, we have a growing middle class. All of this can create investment opportunities. So the question is how to marry, the challenges with the opportunities that exist. To retire at 40, you actually need to become financially literate. I'm not talking about literacy in terms of exposure, going to school or going to the right schools, having the right relationships, and all of that. Those things are important. But in order to be able to achieve your investment goals before the age of 40, you actually need to be intentional about becoming financially literate. One thing you would realize as you go through a lot of my courses is that I talk a lot about intentionality. I am a firm believer in the fact that when you want to achieve anything in life, irrespective of whether it's about finances or investments or marriage or relationships, you need to be intentional about anything that you do. You must have a plan. You must have an understanding of how to achieve the plan. You must know where you are going, and you must take intentional steps to achieve whatever goal it is that you have set. And so to retire at the age of 40 or to become financially independent before the age of 40, it behoves of you to educate yourself, to seek out education or to seek out the knowledge that will help you achieve, this goal. You need to understand the basics of money management, budgeting, and saving. Fortunately, there are a lot of resources available in Nigeria and even online globally, such as books. We have online courses such as this one. We have workshops and a lot of seminars, really, that can help you improve your financial knowledge. Why financial literacy is important is because nobody knows it all. I say this a lot, but I will also say that in the investment world, or when you talk about money generally, things are always changing. The financial landscape is always changing. Knowledge about different products, investment products now, are always improving. New financial products, new investment products are always coming up. And while there's a disadvantage to this in the sense that there are a lot of investment products out there that are not genuine, that can cause you to lose money. However, that is still one of the reasons why you need to become financially literate. You need to learn about the investment products that are genuine, the investment products that are real, and those that are not real. Empowering yourself would ensure that you're able to avoid money pitfalls, investment pitfalls, and just generally achieve your aim of retiring at 40. We're going to talk about diversifying your investments. And I believe that diversification is one key strategy that can help anybody to build wealth. Why do I say this? You not only diversify your investments to explore various asset classes, it also protects you from losing all your capital in one investment. The honest truth is that everybody makes mistakes. Everybody would always invest in one product or the other that can fail. And sometimes the reason is not because you went into or you put your money in a wrong investment. It could just be that you are putting your money in that investment at the wrong time. It could also be that you are cutting your losses from that investment product at the wrong time. And I would talk about this a bit more as we go on. The various asset classes that can help you diversify your investments include stocks, bonds, we have real estate, and we also have small businesses. Sometimes it is also very important. Actually, it is as you go through a lot of my courses, you would see that I talk about this a lot. Consulting with financial advisors. You cannot do everything on your own. You cannot know everything by yourself. Sometimes collaborating with people, sometimes reaching out to people that have the experience in that area is very helpful to create a well balanced portfolio that aligns with your financial goals. The stock market in Nigeria can be a viable way to build wealth over time. Based on my own experience, I have made losses in the stock market and I've also made money in the stock market. And I often hear a lot of people say that people they know lost a lot of money in the stock market, and people would usually refer to the financial crisis of 2008. In 2008, there was a major financial crisis that literally brought down the stock market, and people lost a lot of money. But I would say that the financial crisis was not as a result of the stock market. It was as a result of activities in the global market that dovetailed into Nigeria. Because as at that time, the financial world globally had become more integrated. And so at that point, anything that happened in the global space had an effect on what was happening in the local market. And that was why the impact of that particular crisis was so significant, even in Nigeria. And what we found out was that a lot of people, even as the stock market started crashing, people started, selling, taking their monies out of the stock market. When we're talking about the stock market, I'm going to be talking about trading and I'm also going to be talking about investing. because those are two different ways of approaching the stock market, and those two ways have different impacts on people or on money management, right? Sometimes when the stock market is crashing, it is not because the companies whose shares are listed in the market, it is not because these companies are having issues. It is because there is a general economic crisis that is affecting everything and everybody in the economy. But hear me when I say that this does not mean that companies are going under. And so, as a stock market investor, you need to understand what to do when prices are not favorable for you. You've invested in stocks, you have a stocks portfolio, and then you are looking at the market on a daily basis and you are realizing that the prices of your stocks are going down. The fundamental question you need to ask yourself is, why did I put my money in the stock market? Did I put my money in the stock market so that I could get dividends from the companies that have bought their shares? Or did I put my money in the market because I want to trade the stocks, which essentially means that you are buying and selling within a short period of time? And so you keep buying, selling, buying, selling, buying, selling of different stocks, right? Those are the two different ways of approaching the market. You are either a trader or an investor. For the purpose of this course, we're focusing on retiring at the age of 40. And so, as regards the stock market, I will be talking about being an investor and not a trader. And so, when you invest in the stock market, what it does for you is that you are able to put your money in specific stocks and focus on building your portfolio or focus on getting dividends from these companies, not necessarily watching, how the prices go up and down, because the reality is that the stock market can be volatile. I do my research and I choose companies that, one, pay the highest dividends in the market. I focus on companies that pay the highest dividends. I also focus on companies that have stood the test of time. So, companies that have been in the stock market for a very long time and have consistently paid in dividends during that period. I also focus on companies that are doing well irrespective of the economic situation of the country at that point in time. Because what you need to understand about the stock market is that no matter what is happening in the economy at any point in time, some companies would always be favorably disposed to the economic situation of the company at that point in time, while some companies will be taking a hit. So, your research must also include finding out which companies that particular year or at that point in time are benefiting from the economic situation of the country. And doing that research is what will help you choose the specific stocks that you can invest your money in. So, I'm going to do a recap of that to say that it is important to conduct thorough research before investing in specific stocks, because the stock market can be volatile. And sometimes you would require the help of an expert to do this research. You don't have to do it alone. You can lean on people. You can reach out to stockbrokers, that have that you can verify that they know what they are doing. You can reach out to financial experts to help you do the research before you then put your money in those stocks. Another area that I would advise that you put your money in for the purpose of building your investment portfolio towards retiring at the age of 40 would be real estate investments. Real estate is a popular choice of investments in Nigeria. It has the potential for long term appreciation, and there's also rental income. And one thing that would resonate in all of the options that I'm talking about today is the fact that there is always periodic income from all of the investments that we're going to be investment options that we're going to be focusing on. And the reason is because when you put your money in investments that gives you returns, the idea is that you take advantage of what we call compounding. Compounding means that you have put your money in an investment and then you are getting the returns from that investment, and that return you put it back into the same investment. And what this does for you is that it increases your capital, the capital that you have put into the investment. And then what happens is that both your initial capital and your rental income or your dividend that you've put back into it now begins to generate more income for you. And the more you repeat this process, the more your investment portfolio will be increasing, and the more your interest or dividends or income from those investments would be increasing. And what it also does for you is that you are able to achieve your financial goals faster than somebody that would collect that investment or that rental income and spend it. When you want, or when you're looking at taking advantage of real estate opportunities, you need to look for properties in developing areas or emerging cities where property values are expected to increase. If you put your money in areas where the property values have already gone up, you may not lose money, and you will continue to actually get your rental income, but you may not be able to enjoy what we call long-term appreciation, because there's the possibility that property values in that area have already peaked. And so the growth in the property value may not be as fast, or may not even, be there anymore. So you need to do the research on areas where there is still opportunity for long-term appreciation. And be sure to conduct due diligence. Consider factors like location, infrastructure, and legal requirements. Recently in Nigeria, in some parts of Lagos, we had the government coming in to break down a lot of structures that they termed illegal. And this was in an area where people just bought these houses. People just invested in these real estate opportunities. It was an upcoming area. It was a new development that had just come up a few years ago. And so people had just put their monies into these investments, only to find out that the developers who they bought those properties from built those properties illegally, built those properties on lands that the government had zoned out for maybe infrastructural development, or for roads, or generally that it was just land that was owned by the government. And so all of these structures were destroyed, and the people that invested in them lost their money. Meanwhile, the developers had sold, and they had made their money, and they had left. And so this is why we say it is important to do due diligence, to consider factors like location, infrastructure, and do your research on legal requirements. There are lawyers that can help you check with the government to be sure that that area or that land or that property that you are buying is available, is good for investment. Entrepreneurship and small businesses is also another area we can look at. And in this area, I'm going to be talking about it from two different angles. One is that being an entrepreneur and owning a small business can be very tricky. And a lot of businesses usually actually fail in the first few years of establishing the business. And so I would only recommend entrepreneurship and small businesses where one, the person that is going into this venture already has enough knowledge. Peradventure, you maybe worked with a company that was doing the same thing for a period of time, and so you are well versed on what it takes to develop or set up or even run that business. Or it is a business that you have done your research about and you are very confident that it is a lucrative business, or it is a business that requires very low capital outlay. So the tendency that you would lose your life savings or you would lose your life investments is very, very low. In that instance, then I would advise that you go ahead, with the investments. Another area or another way that small businesses can be a profitable investment would be if you are a big investor in that market. So you are not actually coming to start the business or to run the business. There are some investors that actually buy and sell small businesses. So you could be coming into the space with the idea of looking out for companies that you feel that even though they are small, the objective behind them is solid, the cash flow is solid, the operating model is solid. And so what you do is to invest in these companies for a short period of time. You bring in your own knowledge to help the manager of that business grow the business. You help support the business to a level where you feel confident that the value of that company has grown from when you invested in it, and then you sell your stake in that business to another person. This way you are able to effectively make a return on your investment, and then you pull out, look for another small business, and then just repeat that model. So these are the two different ways that you can um, take advantage of entrepreneurship or small businesses to make money. Starting and managing a small business we've established can be a path to financial independence. And you need to identify opportunities in your area of expertise or passion. Also, entrepreneurship can provide both financial rewards and personal fulfillment. So, again, I would say that for this particular option, entrepreneurship and small businesses, even when you retire at 40, getting this model right, especially where you are buying into businesses, you are not running the business by yourself, you are only providing support for a period of time, and then you sell your stake in that business. It can lead to having personal fulfillment, and this goes beyond just the financial rewards. And because if you're able to repeat this model by doing your research on different businesses and all of this, even while you are retired. This is a model that you can continue to run and will continue to bring financial rewards for you. Now, there's also something called retirement savings accounts. And in some of my other courses, I've spoken about this extensively, where I talked about the fact that in Nigeria, as well as a lot of other countries, there's something called the Pension Act. And this act mandates employers to set up retirement savings accounts for their employees. And these employers are required to make a monthly contribution into that account. However, what a lot of people do not know is that even as individuals, you can also make contributions to these accounts. And what that helps you do is that you are able to take advantage of this opportunity to build an investment portfolio, or just generally build a nest egg for yourself, that upon retirement you can call on these funds and then use that to set up whatever plan you choose to focus on while on retirement. Or it could even be what would then act as a foundation upon which you can enjoy your life from the age of 40 upwards. I would also recommend that we're intentional about staying informed on current financial events, information, anything economic, changes in economic conditions. You need to be intentional about financial knowledge. And what this does for you is that because the financial landscape in Nigeria and globally is constantly changing, you're able to stay informed about changes in economic trends, changes in investment opportunities. You're able to stay informed about regulatory changes and how these affect even your current investment portfolio. And you are always ready, you stay ready to adapt your investment strategy as needed to maximize returns and minimize risks. As an investor, the idea is not that you put your money into different types of investments and leave them there. With information, with knowledge, with confidence that comes from growing in your knowledge of financial activities or financial events, what you are able to also do is that you look at your investment portfolio from time to time. You could even employ the help or the assistance of a financial advisor to help you look at your investment portfolio and make informed decisions. You can choose to come down on some investment opportunities. I would give an example. If you have a real estate portfolio, for instance, or a property that you've invested in a long time ago, and you realize that the value of the property has gone up significantly, you can choose to sell that property and use that money to invest in something else. It could still be real estate, it could be any other thing. But staying informed about investment opportunities or changing economic trends or even regulatory changes helps you to be able to know what is available, what is will help you maximize your returns, or even it could simply be what to do to minimize risks. I remember at a certain point in time, I had a stocks portfolio or an investment portfolio being managed by a financial advisor or an asset management company. Let's call them that. And I remember that prior to setting up that portfolio, they had had a meeting with me where they had asked me to choose risk my risk criteria or my risk level. And when we talk about risk level, you could either be risk averse, you could be risk prone, or you could be medium, risk. And I remember that initially I had chosen a risk level of medium high. But after that, changes in economic trends, both globally and in Nigeria, led me to actually reach out and to the company after a number of years, because I saw what the changes, I saw what fluctuations in economic situation did to that portfolio. And I remember that at a point in time, the value of that portfolio had dropped below my principal, which is the amount I put into that portfolio, meaning that I was making a loss. Two things I want you to take away from this experience is the fact that I did not cut the portfolio. I did not take the loss simply because I thought maybe the loss was going to increase. I did not cut the portfolio. But at the same time, immediately I saw that the conditions of the portfolio as well as the economic conditions had improved, and that the value of the portfolio had gone back up to my principal, or even maybe a little bit above that, rather than uh, taking or cutting the portfolio, selling the stocks, and then putting my money in something else. What I did was to request for another meeting with the financial advisor or the asset management firm, and I requested for my risk level to be changed to risk averse, low risk, something like that, I think. And what that does is, rather than investing the money in that portfolio in stocks or any form of investment product that was volatile, when you change your risk acceptance criteria, what the company then does is to put your money in investments that have lower risk. So it could be money market products, treasury bills, maybe even fixed deposits, and things like that. Those sort of portfolios may not necessarily make you a lot of money, but what it does is to help you minimize risk. It helps you preserve your capital, and so you have more peace of mind about what you're using your money to do. I've talked about this when I was explaining staying informed, but I would say it again because it is important. And that's the fact that you need to seek professional guidance from time to time, or even throughout your journey of growing your investment portfolio. Relying on financial advisors or investment professionals who understand the markets would help you ensure that you are able to make informed decisions, you minimize the risk of losing your money, and just generally gives you the confidence that you are on the right track. However, professional guidance or professional assistance can cost you some money, because these people do not do it for free. So you would have to pay them fees or a certain percentage of your income. But I would still advise that sometimes, if that is what it takes, especially when you are coming from a background where you don't have a lot of knowledge about financial management, or sometimes it could just be that you lack the you lack willpower to do things by yourself, to do investments by yourself. And rather than putting your money in the investments, some people would be tempted to spend the money. And so you need to understand yourself, you need to understand who you are, you need to understand how your relationship with money is. And then, if you know that what is best for you would be to employ the services of a financial advisor or seek professional guidance, I would advise that you do that, because ultimately, what is important is that you're able to reach your goals, whether with the help of financial advisor or not. To wrap up everything we've talked about so far in this module, I would say that retiring at 40 in Nigeria is an ambitious goal, but I know that with dedication, financial literacy, putting your money in strategic investments, this is possible. You need to start early. You need to diversify your portfolio. You need to stay committed to your financial goals. Remember that the journey to financial freedom is a marathon and not a sprint. And so you need to be patient. Sometimes you'll make mistakes. You need to be able to try again. You need to focus on making informed choices and managing your investments wisely, whether that requires the assistance of experienced professionals or not. Also, as you embark on this learning adventure with me, I want you to know that your potential is limitless and that every bit of knowledge that you gain is key to unlocking new opportunities. To stay committed on our events, our programs, and even more courses, please visit Bukky.ng to view all of the information available. Never stop learning and growing. You are only one piece of information away from your big break. Bye.